We want to be able to capture market performance, right? So this says introducing a unique strategy, but really fixed index annuities to us in the industry, not something unique, but it's probably going to be something new to a lot of clients out there. The problem is if you go online and type in the word annuity, you're probably going to come across as many negative articles as there are positive. There's a lot of misconception and as a result, preconceptions on the client's part. I will suggest this to you. When you're speaking to clients about annuities, do not mention the word annuity because that's already going to get them thinking, oh, I've heard of these. I don't know. Instead, talk about what the annuity can do for them. Talk to them about the advantages. Talk to them about the benefits. I guarantee you, by the time you're done talking about fixed indexed annuities in particular, they're going to say, wow, what is this? I mean, this sounds great. And then tell them, oh, it's an annuity, a fixed indexed annuity. They're going to say, wow, that's different from what I've heard. So suggestion, do not mention the word annuity or product. Just tell them what it does for them. So we know that the U.S. government was really already broke, but in fighting the pandemic, um, they're going to get saddled, or I say they, the U.S. government, that's us really. They're going to get saddled with a debt of $6 to $10 trillion on top of already being broke. This is a good point to look at your client and say, do you think with this added debt burden that the US government can do more for you or less? Obviously, less. So, a lot of the amenities that we felt were a given, like Social Security, Medicare, Medi-Cal, may not be so freely given. I mean, there's been some strong talks about slashing Social Security by 25%. So, this is the call to action with your clients. We can't rely on the US government. It's up to us to create that pension plan, the retirement plan, a security net. So that's the call to action here. Now, taking a look at fixed indexed annuities, every time I hear fixed indexed annuity, I think hybrid product. Because if we look here, this double sided arrow streak here is a risk continuum. So over to the left is the more conservative side, right? This is going to be banks, CDs, IRAs, putting your money in a jar and burying it in the backyard, and fixed annuities. Fixed annuities are going to provide total downside protection. You're not losing a penny, but you're going to get lower returns, right? Now, on the way on the other side of that risk continuum, I'll just say that riskier investment options are like equities, mutual funds, variable annuities, or hand feeding white sharks, great white sharks. Now, variable annuities, very sexy to talk about, right? Because we're talking about unlimited growth. Whatever the market does, that's what you're going to get. On the other side of the coin, though, there's unlimited loss. Not so sexy. So that's why I look at fixed indexed annuities like a hybrid because they're right smack in the middle. You're going to get higher returns than fixed annuities, but you're also going to get that downside protection that variable annuities do not provide. So, like I'm saying, there are preconceptions, misconceptions about the fixed indexed annuities. Here to refresh your mind are a list of some of those strengths and key advantages of FIAs. Their safety, of course. FIAs are also going to have that 0% of a floor where you're totally protected against negative market volatility. It also avoids probate. That simply means that if the annuitant passes away, the money goes directly to the beneficiary. It doesn't go through the courts or the state, it goes direct. Liquidity. I think the number one misconception about FIAs is that, oh, if I put my money in there, I can't get it out. That's what Bob told me at the barbecue last weekend. That's not true. That's a baseless foundation because you're going to see that all these products have penalty-free withdrawals starting in year 1 or 2, and typically 10%. So 10% of your total, in year one, I think that's pretty liquid to me. Obviously, it's not 100% liquid. That's called a bank, and you earn nothing there. So that's something to keep in mind. No upfront fees. Now, this is important to know. If you add extras like an income rider and more, then of course there will be fees. But if you go plain vanilla wrapper on a fixed index annuity, no fees. Also, the money grows tax deferred. We love that. You're not getting taxed on the growth. Payout options. There are the standard annuitization options, but these products also come with some nice income options that enhance your income base, the amount that you can take, and guarantees lifetime income. That's pretty nice. And in some cases, when there is zero value in the product, you're still going to keep getting that money for the rest of your life. Also, market linked, as opposed to fixed annuities, which um, the company just declares a cap rate that year, and that's that. With the fixed indexed annuities, you're still involved with the markets. So you have that potential to capture performance upswings in the market. So let's get down to the carriers that we're talking about. So it's Symetra. You may have heard of Symetra on the life insurance side. They also have great fixed indexed annuities. F&G, also known as Fidelity and Guarantee. Now, this group or this company, I bring up to some seasoned WFG agents, and they say, "Oh, I remember F&G. I remember back in the day when I started, I was selling F&G." And then AIG, of course, needs no introduction. They're one of the giants in the industry. So here's the slide where you're either going to hate me or thank me, or maybe both. I don't know. Um, there's a lot of new products here. Let's take a look here. Let's count them all. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. 14 fixed indexed annuities to choose from. Don't let this scramble your brains, all right? I know that's a lot, but that's a good thing to have that choice. Eventually, and in a very short period of time, you'll gravitate towards about, maybe 3 or 4 products that you feel are a good fit for your clientele. Now, this is, I'm just going to say this. This presentation is going to be a very high level view of the products, because if we did a deep dive or even a halfway dive with these, we'd be here for a few hours. So we're going to do a light touch on the products. The star of the show is going to be the website. I'm going to give you a tour of a website that AMS has built for WFG so that you can visit it and find out everything and anything, everything you want to know, and then some stuff you don't want to know about the annuities. It's going to be there in that site. All right. So I like this page because it tells us, it gives us a general categorization of what the carrier products does. So if you have a client that's looking for accumulation, F&G is a good place to go. If you have clients that want income soon, Symetra is pretty good. And for both, AIG can be a good place to go. So let's put our F&G hat on right now and talk a little about the investment options. Obviously, they're going to have the S&P 500. That's the backbone of just about every product out there. But they also have the Barclays Trailblazer Sectors 5 Index. So did you know that Barclays has been around for over 325 years? They started in 1670 something. It's amazing. But we're going to see a little bit of that investment option as well. Now, this chart I really like because it takes the F&G products and gives us an idea of what their strengths are. So we see up here that the first row says designed for. And we see the accumulator plus, the power accumulator, and the flex accumulator. So in this first row, we see that the accumulator plus has a focus on accumulation. The power accumulator has a focus on growth. And I'll take a minute here because I'm always asked, Rick, what's the difference between accumulation and growth? Well, they really could have said BlackRock iShares, non-BlackRock iShares, because with the accumulator plus, there's no focus on the income, right? It's for accumulating value. So that's the case with the power accumulator as well. But here, look at this. They have iShare ETFs from BlackRock. Now, BlackRock, the top asset manager in the country, maybe in the one of the ones in the world. And because of that, that's going to be top shelf performance. So you will definitely get some growth right here. Now, there's also the Flex Accumulator, and we see that for this one, there's enhanced death benefit for no additional charge. We don't get to talk too often about death benefit for fixed indexed annuities, but here we see that there is an opportunity to be able to leverage the FIA and be able to get a death benefit from that. So down here, we see that the Flex Accumulator does have a 10% penalty-free withdrawal starting in year one. This is what I was telling you about. These products have that liquidity, a lot of them starting in year one. So let's take a look at the Accelerator series. This is, we're going to see that there's a 5% first year premium bonus. There is an income multiplier for this Accelerator series. That comes at a cost of 1.15%. And the Barclays Trailblazer Index that I was telling you about, that's going to have a minimum guaranteed participation rate of 100%. That's pretty nice. That means that it will never go less than 100% participation rate. The issue ages are up to 85, and there are 10 and 14-year products. And we see here that there are home health care, nursing home care, and terminal illness features, which means that if the client cannot perform 2 of the 6 activities of daily living, or they become terminally ill, which means that they have 12 months or less to live, they can access some or all of that money with no charge. Obviously, that's going to mostly apply during the surrender charge period, right? And we do see here as well that this has a 10% penalty-free withdrawal after the first policy year. The first one that we saw during the first policy year, here after the first policy year. So let's also take a look at the Power Accumulator. Now, this is the one with the BlackRock iShares. That's pretty nice. There is a 7 and 10-year product. The 7-year starts with a 9% surrender charge. The 10-year product at a 12% surrender charge. And it does have the same home health care, nursing home, and terminal illness features, and does also have the 10% penalty-free withdrawal after the first contract year. So let's take a look at the Accelerator Plus 10 as well. This is a nice splash page. We see that this does come with a 5% first year premium bonus. There is the Barclays Index, which remember I said that it's a guaranteed minimum 100% participation rate. This is uncapped. This applies to any activity that occurs in that index. Right now, it's a participation rate of 120% participation. And remember, it's never going to go less than 100. Now, they like to talk about this, and I can see why. The commission on this product is 7.5%. That is the highest, if not one of the highest, in the industry. Now, there is also an impairment multiplier, which means that if a client starts taking money from this product and they become disabled, they get double the income. So here again, we don't get to talk about long-term care a lot with fixed indexed annuities, but to me, that's a form of long-term care. And as a matter of fact, let's take a closer look at that. Here's an example. We have 69-year-old Ed, and he buys the Accelerator Plus, and he starts taking income, and he's getting $8,100 a year. But then, unfortunately, Ed becomes disabled. He cannot perform 2 of the 6 activities of daily living. So that means he starts receiving $16,200. And there is, you see right here, it says no 5-year limit. That means that it's not just going to be for 5 years. What's going to happen is that Ed will start receiving $16,200 for as long as the contract value holds out. And when the contract value goes to 0, then he goes back to getting $8,100. Pretty nice, huh? So He gets double. When the contract value runs out, he still gets the original amount that he was receiving. That's pretty good. And look at this. Yay. It's available in California. For once, we're not getting kicked around. It is available in California. So let's take a look at Symetra. They also have some nice fixed index annuities. We're going to start off with the Stride product. Now, I will say this is probably the more popular FIA from Symetra, and this is going to be a product for someone that's looking for income somewhat soon. All right, and by somewhat soon, I mean within the first or within the next 10 years. So here's some general information about the Stride. We see that issue ages are 0 to 80 if they are not going to use the benefit rider, the income rider. Issue age is 50 to 80 if they do plan on taking income. And the withdrawal charge period is 10 years. There's a 10-year surrender charge on this. The minimum purchase amount is $25,000, and the maximum amount is $1 million. But as you can imagine, Symetra will make exceptions for over $1 million. Yes, of course. We see down here that they have penalty-free withdrawals after the first contract year, and that's going to be 7%, not 10% of the contract value. Annuitization value available after the first year. And this is an owner-driven annuity. What does that mean? Well, sometimes the annuity has a different annuitant and owner. So this just means that if it's a different annuitant and owner, and the annuitant passes away first, the owner is going to receive the death benefit. All right. So boohoo, California does not have the nursing and hospitalization waiver for the Stride, and this does accept qualified and non-qualified funds for a Roth IRA, traditional IRA, and even inherited IRAs, which are a little rare to find. So the Stride is a single pay product, and we see here the surrender charge schedule. California does get a bit of a break here. Instead of it starting at 9%, it's at 8.3%, and the surrender charge drops off completely after the 10th year. So the investment options with the Symetra Stride are the S&P 500. That's everyone's favorite, right? You're going to see that in just every product. We're very familiar with the S&P. There's also the JP Morgan Efficiente 5. I'll talk about that. And there's also the Putnam Dynamic Low Volatility Excess Return Index. I think they go out of their way to come up with the longest names possible. I think they have contests in the home office. I came up with a longer name. So I'll also talk about that. And okay, so let's talk about that now. I'm just going to call it the Putnam. All right. The Putnam is U.S. built. If you have clients that like U.S. built, this is it. It consists of U.S. stocks, U.S. bonds, U.S. cash. And we see here that over the last 10 years, the average annual return has been 7.1%. So that's pretty nice. The Efficiente 5 is the ETF from JP Morgan. This has been around for probably 12 years, and Symetra has exclusive rights to this ETF. It's made up of 12 asset classes plus cash, and it makes up 5 portfolios. The green boxes are the portfolios. Here's the cool thing. JP Morgan has a supercomputer in New York City, and it's always rebalancing the assets. And then it picks the best performing single portfolio. This is not a mixture of the portfolios. It's not a formula using all of them. This supercomputer is just going to pick the best performing portfolio out of the 5. And this has been averaging about 5.5% average annual return. So let's also talk a little about the Edge Plus and Income Edge from Symetra. Edge Plus, more of a focus on accumulation. Income Edge, obviously, some focus on income. So the Edge Plus has a 5 and 7 year product. There is a minimum purchase amount of $10,000. So that's a nice lower purchase amount. Purchase age is 0 to 85. That's a pretty wide range there. Qualified and non-qualified. And this accepts non-qualified Roth IRA, IRA, and SEP. And here we see that the investment options are slightly different from the Stride. So instead of the Putnam, we have the Morgan Stanley EFA. Now, the EFA is probably the granddaddy of international exposure exchange traded funds. It started back in 1969 and has since become the benchmark for international exposure when it comes to ETFs. Annuitization here also starts after the first contract year. This also is owner driven. And of course, also the nursing and hospitalization waiver not available in California. And this does accept the same funds as the Stride. So the Edge Plus is a 5 and 7 year product availability. We see here that both the 5 and 7 year products start with a 9% surrender charge and drop off at the end of 5 and 7 years. And this does have a 10% annual free withdrawal, penalty free withdrawal in starting in year one. And here we see the caps and interest rates for the Edge 5 and 7. It's important to know that there is a $100,000 premium breakpoint, which means that if the client puts in 100,000 or more, they're going to get the higher cap rates. If they put in less than 100,000, they get the lower rates. But if we look at the 5 year product, there's really no difference between that breakpoint at this time. There is a difference with the 7 year. So if you put in 100,000 or more with the Edge 7, then you do see a difference in that the client would be getting higher caps. Okay. So the Edge Plus is a simple product. There are no step ups or roll ups or income based to speak of. This product is based on capturing market performance, locking it in, and then carrying it forward until the market is up again, and then doing the same, capturing it, locking in, moving forward. So, for example, we see here that somebody puts in 100,000, right? And then in the first year, oh, okay, the market's up. So we capture that and lock it in. Now, next year, the market is up again, capture that, lock it in. Next year, up again, capture that, lock it in. Now, when the market goes down, as we see here, look what happens here. It stays steady. You don't lose money. It just stays steady. So when the market's down, you don't lose. You just stay where you're at. But then the markets start coming back up. All right. So let's lock that performance in and move forward with that. And then next year, up again. So we see here no guaranteed step ups or roll ups. This is based on capturing the market performance and then moving forward with it until the market is up again. Let's also talk about the income edge. This, of course, by its name infers that there's going to be more of a focus on income. The investment options here are also a little different. We just have the S&P 500 and the JP Morgan exchange traded fund, the Efficiente 5. This does also have a $10,000 minimum purchase payment. The purchase age is 50 to 85, and we do see that the surrender charge is 9%, dropping off by the end of policy year 7. So here we see the caps and rates for the income edge. This also has a $100,000 breakpoint. So we see here that if you put in 100,000 or more, you do get the higher caps. We see that here. Now, this has a 10% penalty-free withdrawal starting in the first contract year. You don't have to wait. It's available in the first contract year. And there is a withdrawal rate percentage increase in the first 10 years. I'm going to show you an example of that. But basically, the withdrawal rate that you use to take money out can increase within the first 10 years. There is going to be a charge of 1.2% for that. And this also is a product for someone that is looking at taking money somewhat soon. So let's take a look at the two options for income with Symetra. Now, we see here that there is a level withdrawal option and an index linked withdrawal option. So let's take a look first at the level option, okay? Let's say we have a client that's 55 years old, all right? And because they're 55 years old, the starting withdrawal rate for them is 4.5%. So if they decided to start taking income that year, their withdrawal rate is 4.5%. But as I said, they're going to get an increase, in this case, of 30 basis points a year for the next 10 years. Now, this does not mean that they have to hold off for 10 years. They can start taking income anytime they want. This just means that if they were to hold off on taking income for those 10 years, they're going to be getting an increase in that withdrawal rate of 30 basis points a year. So that's pretty nice. That's the level. So let's take a look at the index linked as well. Same client age, 55 years old, we see there, right? And this person will also receive the 30 basis points a year for the first 10 years. But look at this. The withdrawal rate is 3.25. That's less than the level because look at this, 3.25 versus 4.5. Why? Well, because with this option, once the client starts taking income, this allows them to continue participating in the markets and be able to increase their income. So let's take a look at that. So you see what I'm talking about. Let's do an example of a 55-year-old male with 200,000, and the cost for this rider is 1.2%. And because we're putting in 200,000, we're getting the higher caps because we're past the $100,000 break point. And of course, this product has a 0% floor. So let's take a look at the level income option first. So we see here that we have someone that's 55 years old, and they're putting in $200,000. And because they're doing it at this age, they're getting a 4.5% withdrawal rate. But remember, every year they're getting that 30 basis points increase every year, guaranteed. They don't have to hold off for the 10 years, but if they do, they get that, which means that now that 4.5% has increased to 7.5%. That's the withdrawal rate now, and that means that they can start taking out 16,600 a year for the rest of their life. Now, I want to go back up to the 200,000 up here. Look at this. Over the years, the amount is diminishing, reducing to zero by age 84. By age 84, there is zero value, but they're going to keep getting that lifetime income. This would be a good time to look at your client and ask them, can you tell me any bank account, CD, IRA, mutual fund investment that will have zero value in it and still pay you interest or dividends? There are none. Here, with zero value in the contract, you're still getting a lifetime payment. Now, I want you to notice this at the bottom here. There is a total amount paid out to the client by the age 100 of $599,000. Remember that number, excuse me, 599,000. So let's take a look at the index linked. With the index linked, we have the same client, 55 years old, putting in the same amount of 200,000. But as I said, with this option, it's a lower withdrawal rate. It's 3.25%, but they're also getting the 30 basis points a year guaranteed every year. So that means that the 3.25 increases to 6.25. Now, here's the difference. Remember, the index link started with 16,600, and that's where it stayed. It was level. They get 16,600 every year. Here, it starts at 13,800, but then it increases. It goes to 14,100, 14,500, 14,900. That's because even while they're taking income, they're in the markets and capturing the performance. Now, look at this. 2 years of 15,300. What happened there? The markets were down. So that doesn't mean that they're going to lose money. They're just going to stay level at that point. But then the markets pick up. They're back at it to capturing the market. So same thing here. The money reduces to zero by age 84, but they keep getting that lifetime income. And remember the total amount paid by age 100 with the level, that was 599,000. Look at this, $746,000. A bit of a difference there. So this obviously is going to speak to two different types of clients, right? The level is going to be more conservative. Conservative. They're going to say, you know what, just give me the same amount every year. I want to know what I'm going to get, and I want to plan around it. The index link is going to be more for someone that says, I like to be in the markets. I like to be able to increase every year. Or it might be for someone that says, I have this other source of income, maybe a pension or something that's going to be dropping off over the years as I get older. And here you have the opportunity to be increasing. So that might be a nice, handoff for those between those two products. But it speaks to two different people. It's just nice to have the choices. So let's talk about AIG and what they have to offer here. I like this page because it tells us which products are more focused on what. We see that the Power 5, 7, and 10 Protector have a focus on accumulation. The Power 7 and 10 Protector Plus Income, more of a focus on income. So AIG has some nice options as well. They have something called the Guaranteed Income Growth of 5.5%. This means this has nothing to do with the withdrawal rate. This has to do with the income base. So every year until the client starts taking income, they're going to be guaranteed 5.5% added on to that income base. So that's pretty nice. There's also a couple of choices for income. We see here that they have something called max income. That has a 7.25% withdrawal rate. That's pretty rich. But here's the thing. The thought process for this one is that as we're younger, we're going to spend more, but as we get older, we're going to spend less. So what's going to happen with the max income is that the client will receive that 7.25% upfront, but over the years, it will decrease. It will decrease to 4% guaranteed minimum. So it'll decrease to a guaranteed 4%, but this just means that they can get more money upfront when they're younger. Now, as usual, we have a second option. This time, they can get the level withdrawal rate of 5.8. Here again, this is going to speak to two different people. One that says, I want more money when I'm younger. I can use it. And, yes, I'll spend less as I get older, so that's okay. Or the 5.85% level for someone that says, no, I just want to get the same amount every year. There are some nice investment options with AIG. We see that they have the S&P, the Russell 2000, which is U.S. small cap, which means it's going to be more aggressive. The Morgan Stanley EFA, which we talked about, international exposure. They also have the AQR Dynamic Q Allocation Index, which is global stocks and global bonds. They have the Merrill Lynch Balanced Index for stocks, bonds, and cash. And PIMCO, we're all familiar with, global stocks and U.S. bonds. So let's take a look at some of the income option here. They have something called the Lifetime Income Plus Flex. So this just means that in the first 10 years, you're going to be guaranteed to receive 5.75% increase in the income base and the amount that's going to be available for you to take from for retirement. Now, that means that over those 10 years, that's going to double your income base. Whatever you put in there, it's going to double that income base to 200%. Let's see how this works. So if you put in your premium to start with, over the 10 years, you're going to be guaranteed 5.75 a year so that you double your income base. Now, some people would say, oh, that's nice, Rick, but you know what? I can't wait 10 years. I'm going to have to start taking income in year 5 or 6 or 7. Does that mean I'm going to lose the 5.75 guaranteed credit for those 10 years? Actually, no. They have something called the income, or actually I should say, keep the difference. So this means that if someone decides to take income at, say, policy year 6, well, because of that, because of their age, maybe their withdrawal rate will be 5%. Now the client is upset because they're saying, oh, well, Now my withdrawal rate drops to 5%, but in the meantime, I was getting 5.75 income credit. Well, for the rest of the 10 years, they will keep getting the balance. In this case, 75 basis points. So that's pretty nice. That doesn't happen often. So that even while they're taking the income credit that was guaranteed for those first 10 years will still be paid out. That's pretty nice. So we see here that the minimum purchase amount for these products is $25,000. These are single paid products. And we see the various issue ages for the Power 5 and 7 Protector Plus, the Power 10 and Protector Plus income. So this is the website that we're going to go to. If you can take a picture, I'm going to circle this right here. You see that link? Go ahead and take a picture of it, or write the address down, or if you have a photographic memory, take a mental snapshot, because that's where we're going right now. All right. And this is the website that AMS has created for WFG. It has everything that you're going to want to know about these products, access them. So that is a very important address. And remember, this isn't just for these products I've spoken about so far. Eventually, this will be for all fixed indexed annuities available to WFG. So let me stop sharing here and once again share. Where are we? Here we go. All right. So if you put that address in your subject box in your your internet, this is where you land. Now, if you haven't been here before, you have to register. So if you're a first-time visitor here, you register. It takes less than 2 minutes. It's super easy. Seriously, less than 2 minutes. So once you've registered, let's go ahead and log in. Don't need that. Now, we see here that it's not just about fixed indexed annuities, right? We see here Symetra Life is available, the fixed indexed annuities, and also the variable products that AMS makes available. But, we've been talking about the fixed indexed annuities. Let's take a look. Okay, so what pops up here, and let me just move the grid here so I can get this out of the way here. So what pops up here are some choices at the top. You see this? It says annuity rate and products, carrier contracting, which means that you can come here and get appointed for these products. A big question that I'm always asked is, Rick, I was appointed with Trump for the products. Do I need to get reappointed? The answer is yes, because you were not appointed directly with the carriers of those products. You were appointed with Trump, and now you have to get appointed with AMS because we're the new broker for these products. So you come here to get appointed. You can submit business electronically using Firelight. So all you have to do is click on electronic applications. There are sales tools, and you will be able to see your pending business. And you can do all the product training for the products here. So that's pretty nice. Let's go and take a look at the annuity products. It's taking a moment to think about it. Okay. So up at the top, we see here that there's some additional choices. There's home, MIGA, fixed index, SPIA. We don't have any single premium immediate annuities right now, but we will soon. All products, rider quoting, and illustrations. Now, illustrations, I'm going to tell you this, that's a little misleading. That is not the illustration software for the products. It's a hypothetical calculator. Still useful, but not the software. So if you want illustrations, feel free to contact me or my internal wholesaler or AMS in general, or you can visit the carrier's website directly and access the software that way. But right now, let's take a look at the fixed index annuities. If we click on the drop-down arrow, we have some choices here. So we see the product list, products by account, detail sheet, search, and side-by-side comparisons. Let's take a look at the products. So look at this. All the products are here and they are separated by surrender charge period. So all the 10-year surrender charge FIAs are here. All the 7-year surrender charge FIAs are here. And below that, all the 5-year. So that's pretty nice. If you have a client that says, I don't want a long surrender charge, then okay, let's take a look at all the 7 and 5-year products. Now, up at the top here, you're going to see that it has carrier name. It has the name of the annuity. It has the rating, but you really don't have to worry about that. Um, all these carriers have to have good ratings to be in the WFG platform. The maximum issue age. How old is your client? Well, here's the maximum issue age, the minimum premium to buy the product, the premium type. Is it a single premium product or flexible premium? Can you keep paying into it? This will tell you right here, this row. And then, is there a premium bonus? If so, what is it? And we see here what the S&P 500 caps are, and the fixed rate, and the free withdrawal. Is there a penalty-free withdrawal? If so, is it in year 1 or 2? How much is it? This is all going to be here. Now, if you see a product that you think, okay, I want to learn more about it, all you have to do is click on it. So let's just say we click on this one here. Now look at this. Now we get a deep dive of all this information on that single product. This is the general information. How about rates? Look at that. Now we can see the rates. And by the way, this is online. So you can count on this being the most current and correct rates. Riders, where's my cursor? There we go. Riders, are there any riders? What type are they? Do they have a fee? Yep, it's over here. Withdrawal provisions. What kind of a surrender charge does this have? Is there a 10% penalty-free withdrawal? We see here, yes, there's a 10% in year 2, starting in year 2. And is it available in my state? Well, all you got to do is go to state specific and see if it's available in your state. And it even has a rate history. That's pretty nice. People always want to know, how's it been doing? And then look at this at the top right here, print. You can print out any or all of this information to be able to sit down with your clients and go over it with them. Very nice, huh? So, and then it doesn't end there, but wait, there's more. Up at the top, there's another filter right here. Look at this. So if you have a client, and let's say, okay, my client is in California. So you just click on the drop down and choose whatever state. Let's say California. And then we say, well, this client has, let's just say, $250,000. Now you can write in whatever premium amount you want there. It's not like you have to choose from those. So 250,000, it's non-qualified. The client is, let's say, 56. The rating doesn't matter. Is there a market value adjustment, return of premium? These things here, you can choose the company if you want, or you can just say, show me a choice between all of them. And then more here. And then here, you click on search. You click on search. And now, look at this. Based on the information you input, based on the client's information, it tells you, okay, these products are for your client. Because these products fit your client's profile. How nice is that? So now you can start, you can reduce the pool, and now you can choose from that pool which products they might like. So a lot of great information here, a lot of great resources. And let's just quickly look at a side-by-side comparison. So here, if you want to do a side-by-side, let's say that you want to do a comparison of the 7-year products. Well, under AIG, they have that 7-year protector. Okay, add to comparison. And then let's also take a look at a 7-year product from F&G, add to comparison. And then let's also throw in Symetra, a Symetra 7-year product, add to comparison. Come on. So you have a side-by-side comparison here with as many as you want to see, so you don't have to be toggling back and forth. That information is right next to each other. Look at that. and then they get that. So
Very
that's
cool.
pretty nice. It's a one-stop shop here, a comprehensive resource center. Um, at this point, I think I'm done. I think I have to breathe now. I'm gonna hand it back to Stephanie and see if there's any questions or comments or critiques.
Great job, Rick. That was a lot of information. I was taking
Yeah.
some great notes regarding a lot of the stuff. I wanted to make sure that we had an opportunity to field any questions. So if you have a question, please put it in the chat box. I can monitor the chat real well. Or if you have any comments that you'd like to make regarding the products that they are offering, please put it in the chat. One of the things you did answer for me was that I had noticed about the home the health
Yeah. Home
the
health
benefit.
care and terminal illness.
Yeah, and some of them are not available in California, and I've noticed that. But not just some of these products, but some other products. Is there a specific reason why, or will they ever be available?
They might be, but the main reason is because the California Department of Insurance is broke down. It seriously, it takes years to get anything done, and so if there are carriers that have had their long-term care rider request in the California Department of Insurance for 4 years now, and it's still nowhere near to be done.
Wow.
Yeah, that's so. I'm sorry. That's that's a straight answer on that. It's because the California Department of Insurance is so backed up and just not able to do it. It also has to do with the fact that California is tough on stuff like that. New York is the toughest. It's like New York is like a different country tough,
Yeah.
and then California is very tough. So I think it's a combination of the Department of Insurance and California being very strict.
Okay, so want to make sure that all the products are best suited for their citizens here. Does anybody else have any questions for Rick at this time? Please, he's taking time out of his evening just to be with us and to share with us about what it is that they have to offer for us, because AMS is going to be handling some of the fixed annuities now. So if you got annuities rollovers, you're going to be doing a fixed product because it's the right thing for your client. Ask up. Please ask up. Where you at? Checking the chat here.
I like that. Check in the chat.
Checking the chat. Checking the chat. So could you possibly stop share? Oh, there's Michael.
I can do
Yeah,
that.
I have one question. So I know annuity marketing service, and apologize, I'm a little bit dark. I just got home. Is the is it with the life insurance? Can you access all the information on that website as well, as it just annuities?
No, yeah. You can access Symmetra life insurance, you can access the fixed index annuities, and you can access the variable annuities. It's all there.
Another question. The question was, how soon will the resource be available? And I know personally that the resource is available on the MyWFG website. If you go under product providers, they're not at the top. You have to scroll down to find them because they tucked them away, because you know how they say it's kind of the best kept secret on the web. So sometimes you have to scroll. Would you like to add anything to that, Rick?
No, just that you're absolutely right. This resource is available now. It has been available. So do feel free to visit and just, yeah, take a tour based on what I shared and just play around with it.
Yeah, I know I had one of my agents recently sign up, and he's been doing some illustrations. We're getting ready to do a couple of, this is for the Symetra insurance side, but we've been
Okay.
working with it. So it's exciting to see what we have to work with. And yeah, I recently signed up myself, so it's exciting.
Okay.
Any other questions, please? We got 5 minutes.
Hey,
Does, oh,
Rick,
sure.
Martin had a question there.
He said, can you display the contact information again?
Sure. Here, let me, and you know what? I apologize. Maybe I maybe I didn't share my contact info. I
You
was
did. You did. Some people were just a little delayed on getting on, which is fine. But we also want to make sure that we make sure they do have your contact information. That is not, that's the products you represent. That's the websites.
there we go.
There we
So
go.
yeah, so
There
there's
you
the
go.
website up there, amsfsc.com/WFT. I practice saying that fast. And there's my internal wholesalers contact information. Please keep them busy. Well, keep me busy too. I mean, that's job security. My contact information is over here to the left, and you can call David Schumer or myself, or even AMS directly right here at this number, 800-448-4510. Operators are standing by. Well, not really, right? Not right now, anyway. But yeah, there's the contact info.
So another question came up is, so that they're wondering, so does this mean that Crump will no longer be doing any of the fixed indexed annuity products at all?
That is correct. So by the end of this year, AMS will be handling all of the fixed indexed annuities. That does not mean that Crump is going to be leaving the WFG platform. They will stay on for the life insurance side. So whatever life insurance they're offering to WFG right now, that will continue, along with whatever else they were doing, like disability, I hear. But when it comes to the fixed indexed annuities, AMS will be handling all of that.
All right. I hope that answers your question. And the other question comes: will AMS pay WFG commissions? Excuse me, nightly like Crump?
Um, Actually, that's going to be, I believe that's going to carry over from the, so in other words, it's not up to AMS that we're going to regulate that. If the carrier can do that, then that's something that would happen. If it was happening with Crunk, I would imagine it's going to be happening with AMS because that would carry over.
Is there a way we could possibly find out? Because I
I
know one
will.
thing, especially if there's a run going on, we want to make sure that things hit in a timely manner so we can hit our next promotions.
Okay. And
Thank you.
yeah, but I'll get back to you on that.
Appreciate you, Rick. Any other questions for anybody? We got 2 minutes, 2 minutes to get your last question in. This has been a great licensed agent training, because as you know, when you have your tools sharpened and you have the knowledge to execute, that you will execute well and proficiently, therefore serving not only your clients in the best way, but the providers will serve us, and in return you'll be able to serve your own family. So that's what I like about the wonderful circle of WFG here.
It's a win, win, win.
For all.
Yep.
All right.
All right. So, hey, Rick, thank you so much for taking the time out and being with us. I hope everybody was able to take a lot from what he shared. A lot of you guys have never written a fixed index annuity before. You don't know what it is, and you're like, okay, I got to go out there and I got to regurgitate. No, you're not going to be able to. All the things that he talked about, all of the resources that we have access to. Here's what you need to do: go out there, recruit, build your business, and then you will have people that will need this service. If you have people that have lump sums of money, maybe they're a little bit afraid of the market, and they don't like the ups and downs, and they're afraid it's going to be another 2008 or whatever. It's a lot. People have a lot of different feelings about things. Hey, you have a resource to be able to be able to help them. Now, this is just one tool. This is just one, and that's the beauty of our business and what we do. We have multiple tools. We have multiple services. We have the ability to provide, and we have great individuals like Rick that are willing to give their time and their knowledge to be able to help you go out there and build an amazing business for yourself. So, Rick, thank you again so much for your time and for the knowledge that you share with us. Everybody, take this information, stock it down off in there, and so that it continues to build your confidence that you have the ability to go out there and serve. You have the ability to go out there and make a difference. And so there's no reason whatsoever you should be a secret agent. There's no reason whatsoever that you should be intimidated if somebody says, oh, well, I got this together. Like, no, you've